everyone. Thank you for joining us. My name is Charles Reinhardt. I'm the Chief Investment Officer at Johnson Investment Counsel. I'm joined today by Brandon Zurich, Managing Director here with the firm and a member of our fixed income strategy team. We wanted to join you today to talk a little bit about the markets through the third quarter, give a little review of what's happened so far today, and talk about some of the most pressing questions we're getting from clients as we head into the end of the year. So to start, just a quick level set, kind of a mixed bag so far this year, with the economy continuing to show signs of slowing. Some of the most pressing issues of recent years, inflation for one, have shown some signs of improvement, but at the expense or as a result of continued pressure from Federal Reserve in the form of higher interest rates and less liquidity throughout the system. In the face of that, the S&P is up a little over 13% through the first three quarters. It's really been driven by a handful of stocks and less concentrated indices such as the Dow Jones, probably more reflective of the broader economic environment, up just about 1% for the year. But all of that having been said, I think the real topic, particularly of the third quarter, has been the continued march up of interest rates. And as we sit here today, Brandon, still negative year to date on investment grade bonds, something that seemed pretty unlikely with where we started yields for the beginning of the year. So I think we'll just cut right to the main topic of the quarter. What's going on in the bond market?
Yeah, Charles, last year was driven predominantly by higher inflation and the Fed's fight against it. So, ever increasing rate hikes last year drove the bond market lower. But as you mentioned, inflation has come down. At least the pace of inflation growth has come down pretty meaningfully this year so far. Maybe premature to declare the war on inflation over, but even the Fed in their most recent communication has indicated probably meaningful further rate hikes are unwarranted. So it's in the bottom of the ninth inning of the rate hike cycle. And I think in that vein, a bit unusual to wonder, why are yields still going up if the Fed's almost done? And maybe clues for that can be found in the shape of the yield curve. So until very recently, longer-term bond yields were much lower than short-term bond yields. That's a phenomenon known as the inverted yield curve. And the message that we think the longer end of the bond yield was sending investors was that the bond market interpreted and accepted the Fed raising rates aggressively, but also predicted it would have to cut rates in pretty short order. And so while the Fed just told us it probably doesn't need to raise rates much more, it also prepared the bond market for interest rates to stay higher for longer. In other words, erasing some of those planned rate cuts that the longer end of the bond market had priced in here in the near term. So the third quarter was all about longer term bond yields going up, not short term bond yields going up. And I think the silver lining is that now that the yield curve is roughly flat, so longer term bond yields have come up to match short term bond yields, we think this readjustment period is likely to be almost over.
So long end yields coming up is obviously good news for longer term bond owners over the long run. Painful in the short run. I think one question I get pretty regularly is, with shorter term interest rates still higher than those longer term bond rates, what is the incentive to hold those longer term bonds when you could maybe get a higher yield in a money market fund?
Yeah, we certainly understand that temptation that sort of a risk-free, decent rate of return offers these days. I think at the simplest form, starting yields in bond portfolios are our best predictor of forward returns. Think over the next 3 to 5 years. And with that, bond yields are now at almost 20-year highs. So we are as optimistic as we've been in almost 2 decades about the ability for bond returns to be better going forward. But I think it's also equally as important to remember that bonds aren't a return-seeking asset class. We're talking a lot about our return expectations out of fixed income, but it's really about risk mitigation, right? If you've listened to Charles and I discuss the markets over the years, you'll know we use that analogy that having bonds in the portfolio are kind of like having car insurance on a road trip, right? You might not need it, but you can't predict when you do. And the good news is, even though that tried and true, hedge or offset of fixed income hasn't been all that reliable over the past couple of years, higher bond yields set the market up in a much better position to offset any risk or volatility that, think equities or riskier parts of a portfolio or allocation might encounter. The other thing to understand too is that it feels like we're just in this linear mode of rates doing nothing but going up. But when you're comparing bond returns to cash, if and when interest rates do fall, bond returns can be historically attractive in a hurry, right? I think if interest rates come down about 1%, it's easy to see almost double digit or better than double digit returns out of bond portfolios. So, it's important to understand that temptation certainly is there. And we understand that, with short-term needs, say, tax payments or planned purchases of a home or something, money markets can be a great place to store value, but they're not a full replacement for bond allocations, again, because of the role that bonds play with risk mitigation.
So I think part of what has made this bond cycle so challenging is that role that we want them to play of sort of ballast and stability in a portfolio. For folks that maybe bought a bond yielding 2% a few years ago and are staying here at a market, mark to market below where they bought in, how would you think through their ability to kind of recapture those losses as we march through time? They seem pretty significant based on where those yields were when they bought the bond.
Yeah, this isn't going to make the unrealized losses in bond portfolios feel, any better. But it's important to remember that fixed income and bonds are a contractual obligation of either, government issuers or corporations. And so absent a default, any bond that you own that may have declined in price is still obligated to pay you a coupon and ultimately give you your money back at maturity. And so we are sitting here today at values that are maybe well below the high water mark, but there's also reason to believe that as bonds in a portfolio or in a fund near maturity, that pull back towards the maturity value is a really powerful force. So we're expecting that even if interest rates stay high, you're going to see a gradual recovery of those unrealized losses as bonds near maturity. I'd say the beauty also of building diversified bond portfolios or funds is that every cash flow the portfolio generates today is also getting put to work at much, much higher yields. And so, again, it doesn't make the unrealized losses in bonds feel any less unpleasant. But I think the good news is bonds tend to be self-healing, and a bond dropping from 100 to 90 is a lot different than a stock dropping from 100 to 90 because of the contractual obligation that you're owed as a bond investor.
So that 2% bond is still in a position to give that 2% yield that you were promised originally. It's just coming, instead of 2 every year, it's been negative the first couple of years, and it'll be well above 2 as long as that bond doesn't default.
That's exactly right.
Yeah, good to emphasize that difference between losses from defaults, which we're not experiencing in that sort of short-term pricing. You mentioned one other thing I want to dig into, Brandon, which is the potential for bonds to be a good portfolio diversifier through that potential increase in price if and when rates do fall. My assumption is that environment is most likely to materialize maybe if the economy gets on rougher skis. We've been pretty conservative thinking through what the impact of higher interest rates might have on the economy is, but maybe you could give us all a quick update of what you and your team are seeing in the economic forecast as we head into the end of the year.
Yeah, I think the easiest analogy to use in the economy today is it feels like a tug of war. And what I mean by that is that historically leading indicators of economic downturns are sending us pretty loud warning signals and have been for some time. So specifically thinking about things like the shape of the yield curve, again, when short-term rates are higher than long-term rates, an inverted yield curve, that tends to be a historically pretty reliable predictor of economic downturns. We certainly had that in place, and even to a historical degree. Another one that we've looked at and followed closely are the Conference Board's leading economic indicators. Anytime that measure has fallen, say 5% year over year, that has been synonymous with a recession 100% of the time. That measure's down about 7% today. So we're getting these loud warning signs But it's important to understand those loud warning signs are leading indicators. So they do give advanced warning. And the other side of that tug of war is that coincident indicators and economic activity has almost been surprisingly steady. So the labor market is softened a bit, but it hasn't deteriorated meaningfully. Consumer spending, there are headwinds for the consumer. I'm certainly thinking of things like higher energy prices and student loan payments coming online, but so far consumer spending again has been pretty steady. So we're really trying hard not to ignore the warning sign that those leading indicators are giving us, but also acknowledging that, hey, in the very, very near term, it's probably unlikely the economy slips into a recession in the next, say, month or so. So where we're at today is, I'd say our radar is certainly up. We have heightened sensitivity to paying very close attention to those measures that have been steady for signs that they are continuing to deteriorate. So that's kind of, where we're at from a macro standpoint. And I guess I'd throw it back to you because, certainly there are growing risks in the economy. We mentioned a couple of them, even just simply the fact that the economy is forced with digesting higher and higher rates again, but the equity market doesn't seem to be all that concerned. So I was hoping you might be able to dive a little deeper and help us understand, what cues are the equity market taking and why might it be feeling like it's ignoring some of these risks?
Yeah, I think how solid the return in the equity market has been really depends on what you look at. I mentioned the S&P versus Dow comparison at the beginning of the presentation here, but the S&P is up 13%, Dow's up 1%. Importantly, I think you look at the average stock in the S&P, and it's only up a little less than 2%. In fact, 48% of the companies that make up the S&P 500 actually have a negative year-to-date return through the third quarter. So there is a lot of skepticism and concern out there in the market, and really the area that has been sort of an unmitigated straight line up has been this kind of large tech AI exposed basket of companies that have been sort of dubbed the Magnificent Seven this year. Apple, Microsoft, Amazon, Tesla, that cohort, NVIDIA. Those are great companies. The issue whenever you see a big surge like that of optimism is what do you have to pay for that growth that you're going to get? And right now the answer is about 3 times what you pay for the rest of the market. So that can work out fine if those companies can grow their sales, 3 times what the rest of the market is. I'm talking on a price of sales basis right now. But at 1.6 trillion in revenue last year across those 7 companies, you're talking about a really big growth rate that they are going to have to surpass to get additional juice from here. It's trying to think of things that could scale the type of revenue that are required, and we're talking about like 3 times the amount of revenue that Social Security took in last year from all the payroll tax withholding. So it's a really big leap. There's a lot of optimism. So I think that sets up risks for disappointment down the road, but no doubt that's been the place to hide this year. And by and large, the rest of the market has been fairly skeptical.
Yeah. So it sounds like, the market overall had a down year last year. And if you ignore this overconcentration issue, the average stock is actually down this year. Does that present any opportunities for you in the equity market?
Yeah, it does. I think that we're seeing some things that are historically unusual. This spread in valuation between really large companies and sort of your average or smaller company has not looked this attractive for the smaller companies since the tech bubble. That set up at that time a period when those smaller companies did quite nicely even through the recession and ultimately popped the tech bubble. So I think that there's some potential defensiveness in areas of the market that could actually give pretty good upside as the economy eventually improves. Those smaller caps and even that kind of half of the S&P that's been struggling this year. There's some good quality companies in there that should have really solid fundamentals through any kind of economic weakness that you don't have to pay historically elevated prices to get. So there could be a time historically when you've seen these big gaps. There could be a time in the future when the headline index number looks pretty bad, but the average stock could actually be doing okay. And that's the way we're trying to position portfolios.
Yeah. How about, international stocks? It seems as though the international headline flow has not been great as of late. And I think there's been this valuation opportunity in international stocks for some time, but we've seen a pretty consistent, period of international stocks trailing domestic stocks here. So can you dive a little bit further into what might be, in your mind, the catalyst for international stocks to do well, even in the face of what might be some more challenging headlines, especially?
Yeah, I think that it's important to keep in mind that the types of international stocks that we would buy in our portfolios really are global companies. Now, they might be headquartered in the UK or the Netherlands, but they've got revenues all over the world. And so we're really trying to access just quality franchises and the same types of businesses that we buy here in the United States that may be held, domiciled internationally. That news flow that you talk about has not been good, from geopolitical conflict to just various economic slowdowns in parts of the world, China, for example. There's been not a lot to be optimistic about, but again, that's reflected in the price. And so I think what we're seeing is a chance to have some exposure to some very high quality businesses that happen to be headquartered abroad. And the important kind of long-term portfolio risk maneuver there is that we've experienced a period here, a multi-year period of really amazing dollar strength, and currencies are really hard to predict. We really are not in that business here, but you can kind of profitably over really long periods of time think of currencies as sort of self-reverting sets of data, right? Strong currency sets up economic phenomena that leads to a weakening of the currency and vice versa. And so should the dollar weaken down the road for any reason off of kind of peaks that we typically have seen it weaken from, that international piece gives us a attractively priced cash flow driver business model in the portfolio that also gives us a potential for a tailwind for that allocation should the dollar ever weaken. So there's risk mitigation that you get on top of kind of an attractive valuation story.
Great. I think, in closing, I know you and I talk a lot and work very closely, and we talk a lot about investing for cycles, and that it can always feel uncomfortable in the near term, but that what's going on today is largely a reflection of, what was happening 3 years ago or even more sometimes. And that as we're preparing portfolios and allocations, it's oftentimes what's happening today that's going to drive returns and trends over, maybe the next 3 or 5 years. And it can feel a lot like, especially in the interest rate market, it's just a straight line up forever. But, the higher rates are not without consequence, both from, an economic standpoint and just an opportunity standpoint in fixed income. So, it's certainly been a challenging environment, but, feeling about as good as we have in a while about the opportunity presented in fixed income. It sounds like you and your team on the equity side has no shortage of opportunities at the moment either. So again, we appreciate your time, Charles, and everyone's time here today. If you have any specific questions, we can't possibly address everyone's concerns in a concise way. Please reach out to your portfolio manager and they can get Charles or I a question. Happy to be as helpful as we can. And again, thank you for your all time today.